Welcome to today's market update, where you find out what we're investing in so that you can make your informed decisions on what you want to invest in. And in today's episode, we're going to talk about the TikTok IPO. That's right, TikTok is going public and how you can benefit from it. Also, gold. Should you be investing right now? And if that's the case, what is sexy gold? Because that's what we're looking to get into right now. And should you, with the stock market going up so much, should you be investing in that, or should you be investing in cryptos that are kind of going down and sideways in a buffalo formation right now? Stay tuned, because you're about to find out. It looks like TikTok is going to do an IPO. That's right, you might be able to enter when it goes public. So it'll be really interesting to know whether you are interested in this. You all know what TikTok is, right? It's when your children kind of come up to you and they're kind of doing all these movements. And this one seems to be a very kind of disconcerting one that my children do. As you know, I've got a nine-year-old and an 11-year-old, and they're girls, and so they're always dancing. But when you're talking to them, they seem to be moving all the time. And even I have to admit that I succumb to one or two TikTok movies.
So you bagged him. I'm a savage. Classy, bougie, ratchet. Sassy, moody, nasty. Hacking, stupid. What's happening? What's happening? I'm a savage.
Not my finest moment, but you know, it was a lot of fun. You know, the challenge with this is that where does the money actually come from? That's what I'm always worried about. I know that you think you can go into an IPO and make massive amounts of money, but where does the revenues come from? Because I remember at the time, back when Facebook first went public, I didn't really understand their revenue model, but this is what happened to Facebook. Can we just have a look, Dennis, at the Facebook chart? So it actually went public back in 2000 and it looks like 2012, and it actually went public at a price of $42, right? Now everybody went in because of course Facebook was so popular and still is popular, and all that happened is it just went down and down and down and down and down. It actually went to a low of $17. Now just imagine if you would have invested at $42 and it would have gone down to 17. You would have probably done what everybody did. They bitched, they moaned, they complained, they blamed Mark Zuckerberg, and they sold because they were in such a massive loss situation. Well, guess what? That wasn't the right thing to do, apparently, because then they started doing all their marketing and advertising, and people were allowed to promote their companies, and it just went up, and literally, 1, 2, 3, 4, 5, 6, 7, 8 years later, it went to a high of 300. That is absolutely insane. I mean, I'm sure you would have liked to have invested there. So I didn't get into that because I didn't understand the revenue model. I'll give you another example. Let's have a look at Spotify. Here was another thing that I didn't understand. What is the revenue model? So let's say you would have gotten in here. Have a look at this. This was probably in May 2018. And it went down straight away. Then it did go up a little bit, so you could have made a few percentage points there, probably around 20% or so. But then it went massively down. And again, the same thing happened, the same thing. Everybody's like, well, what's the revenue? We don't understand. What's it all about? And it went down to 104. So if you would have gotten in $165 and it went down to $100, you would have been in a massive loss situation. What would you have done? Exactly the same as everybody else. Sell in a panic. And then 2.5 years later, it actually went up to almost again $300. Why? Because of advertising, etc. So what about TikTok? Exactly the same scenario. Nobody knows exactly where they're going to make their money. It's probably going to be advertising revenue. So I wouldn't discount this one. I missed out on Facebook. I missed out on Spotify. Not sure I want to miss out on this one here. Let me know what you think. More importantly, comment below. Are you going to get in? And if you are, what strategy are you going to use? You need to have a strategy. Now, this is really important because my traders in the trading room next door, they love IPOs. And I know Keith is going to want to go in there. So comment below if you want us to report on it. Do you actually want us to do a video as we are trading it live? And if you do, let us know below. Next, with all the money being printed right now, which is flooding into the market again, it looks like back in 2008. The stock market is massively overvalued. So if you do get into stocks, make sure you have the right strategy. It's like you could trade anything because you have a stop loss. But if you're a value investor right now, difficult to find really good companies to get into. You're going to need some kind of a screening software. Now, in terms of that, you still want to invest and make some money, right? So what we're looking at is gold. Now, when you think of gold, you think, oh, a bit boring, and I do buy physical gold. I buy physical gold, physical silver. I'm not going to tell you where I store it, but I don't give it to somebody else to store. Oh, kind of give it away there. But anyway, but that's another video. And if you just click over there, you'll be able to find that video and watch it a little bit later. I'm talking about kind of sexy gold. What is sexy gold? Well, it's the gold mining companies. So these are individual companies that are literally mining the gold. Now, if we have a look at this, we've got it up here as well. Funnily enough, the ticker is gold. All right, Barrick Gold here. And it's a great company with great fundamentals, which we should have a look at the fundamentals let's just have a quick look at the fundamentals. Okay, look at this. Everything here. You don't even need to know anything about this. You'll still see that they're good fundamentals, because normally you have loads and loads and loads of minuses on things like income and sales and but things like earnings per share this year. Look at this one here. Not only is it absolutely green, it's massively positive. So you can just see there that you're not buying into a dud here. Let's have a look at the chart though, and all we're looking to do, look, follow the money. Always follow the money. Warren Buffett bought Barrick Gold, right? And what price did he buy at? Dennis, you told me just now.
Yes, so he bought around $27.
$27, right? Then it went up massively because Warren Buffett is buying. Look what happened then. This is called a pullback, and we always get in on the pullbacks. Never buy at the top. Never buy at the top, right? We never do. Look at this pullback now. It went down to around 27 and now it's at around 28. If you were to consider getting in right now, you'd be getting in just a few percentage points higher than the great Warren Buffett, who, by the way, never liked gold, right? Because it didn't throw off any dividends, but now even he is getting into these kind of companies like this. So let me know, is this the kind of thing that you would want to get into? And if so, is it Barrick Gold? Is it another one? Or are you just buying physical gold? Please comment below. So the big question, of course, is where do we invest? Because what's happening right now, like I said, with all the money flooding in, everything is going up, but there's no real fundamentals behind it. In other words, the profits are just not good enough. Now let's have a look again at Spotify. Look at this. Look what's happened. It's just massively gone up this year. Absolutely incredible. From a low of $123 to a high of almost $300. So over 100% in that time. And let's have a quickly look at the fundamentals. And why do we look at the fundamentals? Because in the end, you have to understand that companies do need to make money at some stage. Okay, and do you remember I said to you earlier in the video, you can just look and you can see, look at all the reds that are happening here. Look at this, earnings per share this year, minus 133%. Now, without even knowing what the hell that means, you've got to admit that minus 133% just does not look good, right? Earnings per share quarter to quarter, minus 353. Now you could say, yeah, but what about this one? Forget about that. What about those ones? If there's one negative thing in there, it's like warning sign. But things are going up, right? Now let's have a look at a totally different sector. Let's have a look at cryptocurrencies. All right. So what you have here is you have the opposite. You have the price back in 2017 going massively up to 20,000 and then obviously crashing the other way because it went up way too fast, coming all the way back down to around 3,000, I think it was, 2,500, and then really just going sideways in our Buffalo market. So in other words, really over the last few years has been coming down, really, if anything. And let's have a look at the fundamentals, right? Now have a look at this. Look at this wallets. The wallets that where people store their Bitcoin are just opening up like crazy. If you have a look at this, from the third quarter of 2016 to the third quarter 2020, look at that here. Just under 10 million. Now we're at over 50 million worldwide wallets. So you have the use of it going up, but you have the price going down. That is a divergence, and we want to be in this kind of a divergence. We want to see the price going down, and we want to see the use going up. We don't want to be in the stock market divergence, right, where the price is going up but the profits are going down. This is what we want to see. Dennis?
Yeah, and I think that's a really good point, because now we're seeing so many people asking us as well, should we invest in this tech company? Should we invest in that tech company? Because it's just going up and up and up. And I think that's where most people go wrong. First and foremost is that they're thinking about it short term, which means that when it's just going up, but then when they see that they're in minus, right? Because nothing goes only up, up, up. So like with Spotify, up almost 150%, it's going to come down at some point, especially when the fundamentals are not very good. And then if we flip the coin, most people don't want to invest in cryptos because they've seen it's going down. So you have to change the mindset there, because if something just going up, there is something that smells a bit weird. But if something is very low, but the adoption is going up, that gives you a good indication of what the future may hold for that asset class.
So let's have a look at the chart then. So do you think that this is something that people should be looking to get into? Because if you have a look at this, the trend is down, short term up, okay? So it could kind of go down a little bit before it starts going up. And that's the challenge. Most people expect to go into something and they want it to immediately go up. And that is just not how good investing is done. If you take somebody like Jim Rogers, of his partner George Soros, the quantum fund, they made over 10,000% for their clients, 10,000% over a period of years. And he always gets in at the wrong time, he says. He says, I see a trend, I go in big, and then I might be in negative for 6 months, a year to a year and a half. But I know that the trend eventually will make sure that the price goes in my direction. So if you are going to get into something, don't expect immediately to be in profit. Hey, if you are in profit immediately, great. But if you're not, what then? And that's why we use our value cost averaging strategy, where we know at predetermined levels where we're going to get in, just like Jim Rogers. Why not learn from the billionaires in this world? Because if you like something at this price, you're going to love it at this price, and you're going to get married at this price. And what that does is it makes sure we get a nice low average price, and we're in profit a lot earlier than the others, Dennis.
Absolutely. And the interesting thing is that what Warren Buffett always says, if you cannot kind of stomach to be down 50% on your investment, you shouldn't be in the stock market or in any investment. Because, like you said, right, Warren Buffett says as well, if you buy it at one price, why wouldn't you buy it lower? It's on sale if it is a good investment, if it is a good company. And you do that with clothes, you do that with going and shopping food, you always look for the deals, right? But it's something happens when you look at the asset classes, because when it goes down, you think it's going to go to zero, and you maybe sell in a loss even. So
that's what most people do, right? They sell when it's going down. Yeah. That's when we are buying and looking to get into it. So comment below, what do you think? What is better for you right now? Do you think it's buying high at the moment in the stock market? Or do you think it's buying relatively low right now in the crypto market? Go ahead and comment below. I hope you enjoyed today's market update. And if you did and you got some value out of it, please do hit that like button. Thank you so much. Very much appreciated. More importantly though, make sure that you do subscribe to this channel, because we're going to be sending you weekly updates so that you know what we're investing in, so that you can make your informed decisions about what you would want to invest in. And I look forward to seeing you next week.